This podcast is brought to you by the IIEA, sharing ideas, shaping policy.
Well, that was an expectant hush that came over the room there. Good morning, everybody. My name is Fergal O'Rourke. The hat I wear today is chairman of the IIEA. And on behalf of the IIEA, I'd like to thank BNY for hosting this event here in their fabulous offices, which I have to say, I used to live in my previous life across the road. But the views are spectacular here from the south side of the river. Some of you may not be familiar with the IIEA, and I suppose this event today probably encapsulates what we are about. The IIEA's secret sauce is a convening power to get people in the room for thoughtful, considered, insightful discussion, where there are plenty of contrary views, but done in a respectful and challenging manner that allow policymakers in particular to get to solutions which are the best for Ireland. And this is a classic example here where the origins of today happened last February, where we got a number of people in the room from the private and the public sector to look at the whole area of personal investment accounts and how they should be structured. And that led to today's white paper, which went on our website at midnight last night, for those of you who are waiting for it expectantly, and covered extensively in the media today. But I'd like to pay tribute to Dan, who co-authored this with Kieran O'Donoghue, who's here somewhere in the room, at the back of the room there. And I know from my previous life, Kieran, you did quite a lot of the heavy lifting to help Dan do this as well, so congrats. The paper is available at the back, or there are QR codes that will bring you to the substance of it. This is very timely, as many of you will know. The Department of Finance are very keen to get all their budgetary issues done and dusted and signed off before the end of June, before we go into the presidency, notwithstanding the budget won't be until October. So this is absolutely a pivotal moment where the views today, as we look to build to what the structure of a PIA will look like, will be formed in the coming weeks. I hope you all enjoy it. And without further ado, can I pass over to Emily Portman, who is the executive in residence from the BNY Global Executive Team. Emily, over to you.
Thank you. I think I'm mic'd up here, so hopefully that is working. Good morning. It is such a pleasure to be here at BNY's offices in Dublin and hosting everybody. Today we're going to have a very important discussion on Ireland's economic future. For a brief introduction, I'm Emily Portney. I lead our global asset servicing business at BNY. I happen to be based in New York, but I am doing an executive in residence where I'm spending a prolonged period of time in Europe across many jurisdictions, including here in Ireland, and so it's wonderful to be here today. For those who don't know BNY very well, we sit at the center of the financial system, helping clients move money, safeguard assets, navigate global markets, every single day. In fact, we touch about 20% of the world's investable assets on any given day. Our platform spans custody, fund services, payments, treasury services, and issuer services, bringing together scale, resilience, and innovation to support our clients around the world. Ireland is an incredibly important location for us. We have 1.3 trillion of assets under administration here, and we are one of the largest providers of support and services to the wealth management industry. We also continue to grow our presence in the market. We were very delighted to open this new facility, this new office, last year. One of Ireland's greatest strengths is its exceptional talent pool. And that is a very key asset for us and the success of our company worldwide. We also want to remain an active participant in the policy debate here in Ireland and across Europe. BNY has long supported deeper integration of the European single market, and we see the Savings and Investment Union, and particularly the Savings and Investment Account Initiative, as important steps forward. That is why I'm very pleased to open today's discussion on designing a personal investment account for Ireland. We are incredibly fortunate to have such a distinguished panel here today, and I would like to extend particular thanks to Leo Vradkar for moderating the discussion. I would also very much like to thank the IIEA for its partnership over the past number of months with the BNY Institute and our senior leadership team here in Ireland. Considerable work has gone into this research. If designed well, a personal investment account can broaden access to investing across age groups and socioeconomic backgrounds. It can strengthen long-term financial security, and it can help unlock capital for infrastructure, enterprise, and community development. With the right partnership between policymakers, industry, and citizens, Ireland has a real opportunity to turn ambition into action and lead the way. Thanks again for joining us. It's my pleasure now to hand over to Leo.
Thank you very much, and good morning, everyone. As you know, following on from the recent announcement by the Tánaiste, this event will look to build on recent proposals and recommendations set out in the White Paper, the joint IIEA BNY White Paper. And this expert panel will examine the product features and the practical steps necessary to launch it in 2027. Discussion will focus on how to operationalise the PIA scheme swiftly and effectively, and also the range of investment options that should be available to participants and ideas to promote financial inclusion for the benefit of wider society. So very briefly, our panellists are Dan O'Brien, who's Chief Economist at the IIEA to my left, Professor Niamh Moloney, who is Professor of Law at the London School of Economics and is a specialist in EU financial markets regulation, and Finnegan, who's Head of Function in the Cross-Sectoral Policy of the Central Bank of Ireland, and Paul Kilcullen at the end, who is BNY Ireland Country Manager. So I might start with Dan as the author of the paper. Having co-authored the white paper, Dan, what are the key proposals or recommendations that you think PIA needs to follow in order to be a success?
Well, thanks, Leo. Simplicity, by far and away, the most important thing. I suppose most people aren't usually financially aware, and so the importance, I think, of simplicity in government is really important. And we also say why, just to give an economics perspective on why this is so important. For 40 years, there was effectively no inflation. We lived in a wonderful period of price stability. In the second half of 2021, over a period of 18 months, the cost of living rose by a quarter. Now, that had the effect of incinerating quarter's value of deposits, say banks, be as non-interest rates, or effectively zero. In cash terms, that comes to tens of billions. It was the second biggest period of wealth destruction we've seen in this country, the property crash. So it's an absolute imperative, in my view, that a public policy focuses on protecting people's wealth so we don't have another period of that sort of wealth destruction.
I've never heard it framed that way before. It's a great answer. I think people have to have a lot of money on deposit as being very wealthy. You don't think about the destruction of that wealth that occurred because of inflation. So moving on to Niamh, I ask you more or less the same question. What are the key factors for success? And then also, what can you learn from other countries in design and regulation? Because I know reading the papers, people talk about the UK model, they talk about the Swedish model. I'm sure there are many other models out there. Can you tell us from your experience what we should do here and what works best?
Thanks, Leo, and thanks so much for having me this morning. This is one of the biggest policy interventions in retail markets for 25 to 30 years. It really is. So I think it's worth reflecting on that. And as Dan said, it is a potentially super exciting way of really increasing household returns. I guess maybe a couple of points on sort of what are the success factors. The first thing is sort of not to obscure the basic fact that PIA and ISA or whatever it is a wrapper, it's a platform. And that doesn't obscure the fact that the returns to the household are based on risk. So that any return to the household will be correlated with market risk. So ultimately, why these things succeed is the investor base, the household base, has the capacity to take on and manage risk. And that's kind of obviously associated with trust in markets and so on. So I guess the job then of the wrapper platform and how it's distributed is to manage that to the greatest extent possible. So you're supporting households and getting access to that risk premium in the safest possible way. I mean, there's loads of examples of these. I mean, the one that's always getting a lot of attention, and down in the IIEA have done super work on this, is the Swedish one, the ISK. I think, as we all know, the ISK, sort of 1 in 4 adults have one, close to 4 million Swedish citizens. It is hugely successful. I think a third of Swedish GDP is now saved through these ISKs. And the hallmark of those, very much going to Dan's point, is they're simple. They're easy to access. The tax is paid by the ISK provider. It's a kind of a top-slice tax system, so it's super easy to operate. It's a really, really good model. But I guess the thing to keep in mind is the ISK sits within a very distinct market. There's very deep equity markets, very extensive financial inclusion, high levels of trust, and a lot of experience. Really go back to the 1970s in how to design these sort of tax vehicles for household investment. And I suppose one of the things it's telling us, it's a long game. So we put these products in place, but I think it's important to keep up the momentum in terms of how they're designed, how they're distributed. And maybe just the final point I'd make, Leo, is the ecosystem it sits in. So one of the points the Commission has made of PIA, and I think it's kind of the right way to think about this, is you shouldn't have to take financial advice. These things should be organised and sort of put together in such a way that you can kind of buy them off the shelf with, let's say, good websites, good digital interfaces and so on, which I think must be right. But I think associated with that, we need to think imaginatively about how we do distribution, so how we do investment advice. So when you're dealing with an investor base with limited experience, how do we ensure they don't have to pay for super expensive investment advice? That's not a good way to go here. But there's something in the middle through which we can guide and support households in accessing these products safely. So, one thing I'll put out there, one thing the UK is experimenting with right now is a thing called targeted support. So it's kind of a cheap form of investment advice, not full bells and whistles, not fully personalised, but it is a way of getting good investment advice out to the household sector. So kind of placing it with a wider ecosystem where you're getting supports to households so they can access these products safely.
I'll move on to Anne-Marie. Really from a supervisory standpoint, what are the key consumer protection concerns when launching a mass market scheme such as this? And how do you balance the provision of choice and, on one hand, and investor protection on the other?
Thanks, Leo, and good morning, everybody. I suppose I'd start by saying, kind of what we expect already. So, our expectation around retail investment, how firms engage with retail investors is, they're bringing forward products that meet their goals, that they think about individuals from financial capacity, think about, their risk appetite, and they're delivering products I suppose that can deliver value for money, and meet those objectives that we've already identified here. But I think it's really clear that when we start talking about targeting a much broader cohort of potential retail investors, it really brings consumer protection sharply into focus. It's going to be really important that protections are there and they're actively implemented. So I suppose if I were to highlight kind of 3 key areas, I suppose the first one would be a concern that products are put within this wrapper that actually don't meet the needs of consumers. So that point around suitability and appropriateness is really key. I think the second key concern is around consumers not understanding what they're getting. I think that goes to Niamh's point around support, advice, good quality information. And I suppose also, that point around developing financial literacy. And I suppose that goes to the point around this being, a long game. That's going to take time. We won't have that done by June or by the second quarter of next year. And I suppose the third, consumer protection concern would be around, products or structures that don't offer value for money. Because if the return is eroded by, layers of fees, we lose that really important goal or benefit that Dan has focused in on. That this is about protecting the real value of people's funds. So it can't be eaten up in fees and charges. So I suppose just to say, there are already a range of existing consumer protections both in the EU and the domestic framework. People will be familiar with protections under MiFID, protections under the Insurance Distribution Directive, and indeed protections under our own domestic consumer protection code. So just, I suppose, to briefly touch on the concept of choice and the range of products. I think it is important that there is, a good range of options. So that's important from a diversification perspective, so from that risk management perspective, but also in terms of people being able to select products that meet their needs. Because we are talking about, as I say, a broad cohort of potential retail investors who will have different needs, different levels of risk appetite. So I suppose overall, what's needed is a good range of options, products that are suitable, with strong consumer protections in place and being adhered to.
Thank you. So, Paul, can I ask you how quickly can this be done? The Tánaiste has talked about it being up and running in 2027, but what quarter do you think is achievable, and what needs to be done between now and then to make sure that is done?
Don't you love when the moderator goes slightly off script and gets a bit more pointed about quarter? So I was going to hedge my bets as regards 27, and now, I think Q2 next year is realistic, is a realistic time frame, because what Dan talked about is the destruction of wealth. And then it's incumbent upon us as an industry to move with a sense of urgency and to move forward at pace. To give a bit of context, myself and two EC members, both Irish as it happens, met at Tánaiste in New York last year. And in that meeting, we kind of outlined the danger of complacency in Ireland and the desire to act with competitiveness. And then also about creating an investment culture, and we followed up in writing, and particular in relation to the younger generation. So this is something, I personally, we as a firm, feel is very important. Destruction of wealth is a strong word, and I think it summarises it well. Now, what do we need to do to kind of move it forward? And I suppose there's a couple of key decisions that need to be decided. Certainly the scheme, the nature of the scheme is one. The tax requirements and the tax reporting nature in relation to meet the objectives of the government and simplicity. The range of investments, stock shares, government bonds, unitised portfolios, how big that shop window is, and making sure that the shop window is appropriate to investor type is clearly very important. And then the eligibility, like working on the assumption. I think day one, an account, personal, one individual has an account or multiple accounts. But I think as a day two, it will be very important, and we may talk about it a little bit later, is that we kind of open it up to the younger generation, starting from when they're born.
Just before I go on to the next set of questions, is there anything anybody in the panel heard from each other that you'd like to pick up on? Strongly concur or strongly disagree? Yeah. One thing that has kind of hit me from the debate is the whole issue around how it can be taxed. And in the white papers, and I think you say the most simple thing is a system whereby somebody doesn't have to file returns. And as somebody who went from 20 years at PAYE to being self-employed and taxed in 2 different countries, I can tell you, I don't know what that means. I just hope my accounting's good. And then there's this issue then as well, of course, that this isn't going to be a giveaway like SSIA. This is a very different thing. And if it's going to be a flat tax on the whole pot, that actually could be quite onerous. And I know in Sweden it applies above the limit. Would anyone like to just give us some thoughts on what's the best way to treat this in tax terms? Because it can't be tax-free, that won't fly. So how's it done in tax terms?
Well, okay, so if we look across peer countries, so taxation is primarily personal income tax up twice the majority of revenue to any country, your country. Then comes VAT, then comes corporation tax. Now, we're a little bit unusual with corporation tax. We know it's much higher now compared to most other countries. But wealth taxes are actually a tiny fraction of the of government's take in most countries. So I wouldn't rule out the idea of certainly having a first big chunk of it being not being taxed on the basis that it's not a major fiscal issue. It's not going to cause public finances. And then all the issue of filing tax returns, if people have to file tax returns, kill it. It's why workers have to go and get accounted for, do it themselves, which is a pretty complicated business, even for me, to be honest. That would kill it. So certainly nothing in terms of taxing an obligation on a tax return as a result of this, and potential for a portion of it being not taxed on the basis that it's not going to get fiscally significant.
Everyone agree on that already? Any further thoughts on tax?
Yeah, I mean, I think Dan's absolutely right. It has to be simple. I'm going to word up properly. It has to be super simple. I think there's another thing, though. This is a really big public policy decision as to how we're going to use our tax capacity as a nation and the extent to which we use it to encourage, financial investment. So it's a really, really big call. And that's the classic kind of call government should be making. And I guess linked to that is kind of how you do this. And part of me thinks it's sort of linked to what households kind of used to. Because when you think about sort of all these different products across Europe, they're deeply located in that context. How do people behave? Do they buy houses? Do they buy pensions? What's the kind of history of financial investment? So you've got, say, the UK system is a 20,000 tax-free amount that you put in every year. April is ISA season. Everybody knows what it's about. It's all over the news. It's thing. The ISK is a top slice, sort of a kind of a wealth tax thing based on the value of the pot. So I think part of it is, what are people going to respond to? What do they understand? What do they find easy to engage with? So as well as how much tax they're actually going to take out of it, is how the population is going to sort of respond and engage with it. Because that sense of, this is a thing I understand and I can work with is sort of key to this choice.
Yeah, and I think I'd just like to double down. Like, if you look at any major policy initiative and success, there has to be a catalyst for change. And having a tax incentive will be fundamental to kind of drive that and to drive that take-on.
Okay, we might turn to the issue then of investment options. Going back to you, Niamh, Paul, in the past highlighted agreeing the investment options as a key requirement to enable launch. Investment choices available, experience in the UK. What's your view on whether individual stocks or crypto should be excluded entirely in order to protect people, presumably? And then I'll cut to Dan right after you. This whole issue as to how much and to what extent there can be a home bias or home advantage, because I think people, and certainly the government, like the idea that this money is being invested in Irish businesses and Irish startups and scale-ups and so on.
Yeah, I mean, this is a great question because this is a big intervention, right? It's a major policy intervention. So it does throw up a really big design question, and it's this, to what extent does the government want to be on a spectrum of paternalistic right down to sort of the opposite end? And that's fine. That's an absolutely sensible call for any government to make. So if you're making kind of a paternalistic end of this, you obviously want to manage risk to the greatest extent possible. And any financial and economic textbooks will tell you diversify, so that's kind of heading you in the direction of investment funds. But then equally, you really want a government to be absolute sort of recipe for what a product looks like. You must have, equity funds and a bit of a bond fund and a bit of something else. That's kind of very interventionist policy making. So then, obviously shares over the long term, 10, 15 years, whatever, you're going to be getting, kind of those kinds of returns. So that's a kind of a place in the middle. And then if you're going further along kind of the spectrum, you have a look at autonomy, choice, market returns. If you're supported properly within an investment advice ecosystem, it's all about the wrapper. It's just the wrapper, and you can kind of put whatever you want in it. My own sense, again, kind of repeating what I just made, is it kind of goes back to appetite, experience, culture when it comes to these kinds of products. And taking the crypto point specifically, I mean, that is a very new kind of asset It's something everybody from regulators to asset managers, right through obviously to investors, we don't have the through the cycle experience of it. We don't really know how it's going to play out over a 10, 15-year cycle. So I think making very big calls, which may be right, but making them right at the start of a product is inherently kind of fraught with risk. Just a quick look across the channel. So the UK has what they call the innovative ISA, this is a special one, which is for essentially less liquid securities. And it does have a particular kind of crypto asset in it. But if you look across Europe generally, you see less of the crypto. So I guess super short answer, it's a policy choice for a government to make. And I always think the less wiring a government does, probably the better. But the crypto case is probably such a one.
That right? No crypto. For starters. But gold. Gold, okay. It's certainly, it's gone. We've clearly gone through many cycles for gold. So yeah, that's okay. But just the crypto thing, completely complicates crypto. Just in terms of different in Sweden and the UK. So UK, they can stock market forever. Sweden is very unusual, like Switzerland for a country with size. It's a lot of listed companies. So there's a lot more options in terms of home investing. So, I don't want to rain on the parade, but, there is a potential downside from this in that if 20 billion of deposit comes out of the banks and it's invested in global assets, that's 20 billion less than the banks have today. And let's just remember, it can often be said this money is sitting doing nothing. It's not as though the banks take your deposits, stack them up in bottles of cash and put them in a dusty vault. That's not how it works. Banks obviously need to make money off that, they lend it out. So Ireland is very typical, as a typical European country, in that our financing, the way we fund our economy is via the banking system. So there is a potential downside here in terms of deposits leaving the economy. That's very good for the people who invest because they'll get a higher return. But there's a potential downside that more will leave than, say, Sweden, because there are fewer investing options within the country. So that's one thing I think certainly people who are designing it are fully alive to.
I might ask both Henry and Paul to comment on this same question, but then maybe touch on infrastructure. Again, we often hear this idea that people who have money to invest would like to feel they're investing in some way in helping with the housing crisis. Obviously, feel free to reflect on what we've heard already, but is there anything in that?
Well, I'll start, I suppose, just by commenting on some of the comments. I suppose we need to be careful. I mean, this isn't a view. These are just, I suppose, considerations. So thinking about the range of products or the range of assets that are appropriate within something like a PIA. I suppose, interestingly, the EU recommendation speaks a bit to this. Talks about potential exclusions. So it speaks to, potentially excluding crypto and thinking about excluding, very highly complex products. And I think that very much goes back to, one thing that will need to be thought about is how the choice or range of products, I suppose, impacts on complexity and understanding. Those things, I think, need to go hand in hand. In our own research, we found actually that sometimes the number of different products overwhelms. So there might be a piece there just in terms of thinking, how you, potentially, without impacting on choice. So, these are trade-offs, but how you select an appropriate range of products that can meet the needs of individuals, that they can engage with and that they can understand. I suppose in terms of that broader infrastructure point, I think there's, maybe some concerns if this becomes overly directed or focused at specific, types of domestic investment or, I think you start to bring in, I suppose, potential concentration risks, and I think potentially impacts the overall risk with products. So I think that certainly has to be one of the considerations.
Yeah, I'll double down on that. I think you have to allow the investor reasonable choice. And I think if we start kind of putting in arbitrary investment limits and so on, it will get very difficult to administer and support. Like this about creating an investment culture. So on the specific point of infrastructure, it's a challenge because it needs to be liquid. Infrastructure, we know, is very long-term in nature, heavy funded. We talk about the wind generation that we need, infrastructure, housing, the electricity grid. But I feel confident that when we have a situation where we're getting capital that can be used, then solutions will evolve. Like we have the fantastic NTMA agency, forming a kind of government bond that's invested in infrastructure and supporting that underlying liquidity. We've got the LTIF 2.20 regime, which kindly supports more liquid investments. So I think we have to have choice. I do think home bias is appropriate, but it should not be directive. But I would say is that, let's get this up and running in relation to in a reasonable way, in a reasonable time frame. And as we said, additional products will be added in time. What we have to fundamentally all agree is channeling investment into the markets is good for society, and we need to kind of create an infrastructure support. And what the government is doing in the leadership of this initiative will achieve that objective.
I turn to the question of creating an investment culture in Ireland, and spending a lot of time, as I do now in the US, I really see how different that is. I understand now when I watch the American news why the ticker tape is on the bottom, because everyone's investing something. That's so not like that in Ireland. It's your house, it's your deposit, and that a very small group of people think about investment. But that is actually changing a lot with younger people. I really see that people who are younger investing on their apps, in particular on their phones. And I know, Paul, you touched earlier on how we create that investment culture, particularly in relation to younger people who might just be at college, might have much income, might be in the gig economy, might have much to invest, probably are just about or just have been auto-enrolled. Can there be something in this for them?
Well, I think, from the outset I talked about last year, personally I feel very passionate about the younger generation. There's a couple of reasons about that. I think it's very important that society, Ireland, has been a very inclusive economy. We know that there's a lot of wealth trapped in the older generation, and we need to give the younger generation a start. Now, if you take the US, they've got the 539 scheme and the 540. The 540 will relate to it's the Trump accounts, which BNY is delighted to administer. Starting people ages 0 to 3 with $1,000, many firms, including BNY, are matching that to give them a start in life. So I think in creating an investment culture, truthfully, my 13-year-old son 2 weeks ago said, "Dad, can you help me invest?" And I said to him, it's actually quite difficult, Leo. There is no real structure. I said, so we'll talk about it and we can do it through my name. But there is actually no way. So I do believe that the sooner we start, and sometimes people talk about amounts. And the research talks about compound interest rates, where only a third of Irish citizens, I think 1 in 3, understand the impact of compound interest rates. The best way for people to understand it is to actually to see their investments growing. And if as a parent you put €50 a month into a kind of a savings account, when they turn 18, based on a 5% return, which is conservative, that's 15,000. That gives them a start in relation to kind of life. If the government matches it by another €50, that's 30,000 in relation to apprenticeship, learning, housing, given that real sense of equality. So feel very strongly, Leo, that it's not a day one requirement, but if we get it right for the younger generation, I think that will permeate right the way through all socioeconomic groups and all age groups.
Anne-Marie, I might ask you to talk about communication. Should the PIA have rules on how it can and cannot be marketed, particularly around expectations that this is a get-rich-quick scheme.
In a word, yes. But I suppose to expand on that, yeah, I mean, like, both marketing and provision of information about this is going to be absolutely key. And look, again, you know, the existing framework recognises this. You know, looking at marketing, you know, there are detailed and prescriptive requirements around marketing, both in terms of, you know, the domestic code and again MiFID and the insurance distribution. So, you know, advertising has to be clear, fair, accurate, not misleading. Might sound obvious, but, you know, we really need to, focus in on that. I think importantly, there's this concept that you can't seek to influence the attitude of the consumer through ambiguity, through exaggeration, or through omission, which I think is really, really key. And then also a requirement around, you know, benefits and risks being given equal prominence. And I suppose overall, that really just goes to, you know, giving good information. So I would put, you know, alongside marketing, you know, this focus that we have in revised consumer protection around informing effectively. So, you know, firms really thinking about how they can support and assist retail investors in terms of, you know, understanding the features of the products and, you know, empowering them to make, you know, good decisions in their own interests that, you know, align with their financial capacity and align with their own, you know, longer-term financial goals and indeed their own risk appetite. So I think that's going to be absolutely key.
Dave?
Yeah, I mean, I think I would agree there in the set. I think I've maybe put in this kind of backstop on it, because I think you make a great point to you about the US. It's always the one we look to, the equity culture and so on. But of course, the US has a different pension system, it has a different social protection system, it has a different entrepreneurial spirit. You know, it's the kind of going to the West and the kind of pull yourself up by your bootstraps. There's a whole different sort of way of thinking in many respects. And they've been investing, we know, since Wall Street crash, and regulation has followed that kind of trajectory. So I think the lesson I would take from that is, A, it's a long game, but B, you have to kind of let it evolve organically. So there will be a cohort of households who right now have discretionary funds, because it has to be discretionary funds, to engage in this. What you don't really want is someone taking the 15,000 they've saved incredibly hard for their first deposit on a house. They want to put it in the market, and in 2 years' time, fingers crossed, you really don't want to be in there, because we know you've got to be able to stay through the cycles of the market. So I think it's being cognizant to all the things guys have been saying, but don't sort of aggressively expect major household change in a short-term period, and then to adjust and flex the design around these products then, and the regulatory framework around it that needs to be over kind of those sorts of processes.
So Dan, just in terms of the research, what does that tell us as to what are the barriers to people in getting involved in investments, and how can that research inform decisions governments to make?
Yeah, well, in terms of the financial literacy piece of helping people understand these things. So one of the things we suggested before was that, you know, products would be graded in terms of risk from, you know, then 1 to 10. So maybe a 7 in terms of riskiness would be US equities only. Put all your money here, to put 10 grand into US equities. You know, we know US equities could crash by 15%, you could lose 15% of your within 6 months. A low risk, maybe a 2 or a 1, would be, you know, a product that comprises global equities, A-rated sovereigns, European infrastructure, Asian commercial market. So that's a highly diversified portfolio. It may not be spectacular. One component of the portfolio might decline in value over a period. One might rise. You know, it's the classic of that investment. The more diversified you are, the safer you are. So that you kind of, and maybe the central bank would oversee that in terms of regulate to make sure that how the providers are rating their products to ensure that there's some oversight.
In the white paper, you talk about unforeseen consequences. Can you foresee those?
Well, the unforeseen consequences that I've alluded to already is that concern that there be less money in the banking system to let back into the domestic confidence. So may have a potential downside for all economics.
In terms of regulation and supervision, Anne-Marie Finnegan, do you feel the regulator needs to take actions now to address those concerns?
Yeah, it's a tough question. And I suppose some of these, unintended consequences were actually discussed at the Savings and Investment Forum back at the end of March. And I suppose maybe somewhat comforting in terms of financial stability concern. The view was, that you wouldn't want to, overstate the probability of that risk materialising. And I suppose that goes back actually to some of the conversation we've had this morning, that actually, getting this right, building interest in it, building involvement in it, building an investment culture is actually going to be a multi-year project. It's probably not going to happen instantaneously. And actually, in fact, mobilising, a fraction of what's currently on deposit and getting it into investment would be a huge success. And really would mark, a significant move, I think, along that path to developing, a more kind of sophisticated investment culture within Ireland. But of course, the Central Bank has a financial stability mandate. We will continue to monitor, the dynamics of the markets, and any shifts in flows will be kept in monitoring. Yeah.
I'm going to turn to Professor Moloney next. The PIA, as we know, is an EU initiative as part of the Saving and Investments Union with the European Commission's aim to increase the availability of saving and investment accounts and also personal investment accounts around Europe. In terms of regulation, is there room for the ESMA and ESMA to take on a greater role in the European capital market, similar to the Security and Exchange Commission in the US? And a PIA needs to be usable without everyone needing paid advice. So how do we draw the line between guidance and advice?
Yeah, it's really tricky stuff. So, let me just hook you. Yeah. So, just go to that first point about the current European central regulator, ESMA, or kind of soft supervisory convergence central regulator. I've been kind of wary of that having much more of a greater role in this space for the simple reason that investment culture is highly domestic. It's a deeply rooted domestic kind of thing. So you need your national regulator very close to it, understanding how regulation works, understanding what people are responding to, kind of understanding the nature of the distribution sector, how enforcement is going. These are very, very local concerns. And there's obviously a role for the European kind of structures in terms of sharing best practice and risk warnings to regulators. Funny stuff might be going on in crypto somewhere, you need to be aware of that. So I think there is definitely a role in kind of the supporting, guiding, advising, but I do think that sense of monitoring, supporting, protecting consumers, that absolutely has to be at the national level, because the more you pull out of the national system, the harder it is to keep an eye on what's going on. Going to your point about the guidance and advice, I think that's the gold ticket, and that is a really hard nut to crack. Because on one end, so we know a couple of things. We know that retail investors really, really dislike paying for investment advice. They just don't like doing it. A couple of reasons. It is rightly expensive because it is very very costly from a regulatory basis. So it's expensive for firms to provide. But investors are kind of used to paying, if you like, for advice through commissions. Is kind of how they're used to it. So seeing a fee for advice up front, we know from the research, they just don't want to pay that. So that's an issue. That creates an advice gap because households, there's a resistance to investment advice. They don't want them in the markets either without anything. So where do you put that line between the regulated gold standard investment advice and some kind of control that isn't just a website telling you basic things? It's a really, really hard thing. And a lot of member states are kind of experimenting with it. The UK has a particular experiment on the way right now, as I said, called targeted support. I think that is something that is really worth looking at. My sense is that's the golden ticket. You can kind of break open some kind of easier to access, less costly advice that supports investors through their investment journeys, that is really what we're about. But there's a lot to do there.
Well, I might ask you if you'd like to comment on that, but also how could the scheme enable a broad range of investments without being overly complex?
Yeah, that is a challenge in relation to give choice. And the way I describe it, I think it needs to be a funnel. And with technology nowadays and the tools that are out there, you know, you kind of have the window and you help the individual on that journey. You help to assess their level of sophistication. You help, as Dan says, them understand the risk implications, potential liquidity implications, and that funnel should narrow as you get almost less sophisticated. And I think it's kind of getting that balance right, because, like, so for example, if I or our team here in BNY want to buy BNY shares, you know, as part of the scheme, you know, they should be allowed to do it. They're sophisticated to do it. Equally, you know, buying a single stock for a certain investor mightn't be appropriate. But technology and the investment tools have come quite a way. The wealth management industry in Ireland has become increasingly sophisticated and can support, and I believe has the capability to support investors on that journey. So I think Leo, it's all in the art of the manageable, and what it requires is a little bit of leadership that the government has shown, a little bit of collaboration in the industry working together to get it up and running, and I think I have no doubt it will be extremely successful.
Yeah. So with options, inevitably there is more risk. How do we frame and explain those risks to people honestly without putting the knot all together?
Yeah, and I think that's a real challenge. You know, our research showed, you know, that risk aversion that people have. And I think this actually links to the advice and support point, because I suppose the other thing that came through in our research are, you know, these knowledge and understanding gaps. People feeling they don't know where to start. People feeling, oh, this isn't something for me. But I think part and parcel of that is a bit of fear, and that, I suppose, risk aversion. But I mean, I've commented already, it's really important that people do understand risk. So how do you do that without, I suppose, scaring them off, for want of a better word? And I think it's about really thinking about that, because I think sometimes when we talk about risk, we're very much in the warning space. And look, I'm a regulator, I'm part and parcel of that. I'll put my hand up on that. And that's important, because, you know, where there is, you know, risks, they do need to be highlighted and flagged, and we talked about that in, you know, marketing, advertising context. But I think alongside that, there has to be, I suppose, supports for people, and this is just very much what you're talking about, helping people to understand risk. So awareness is one thing, but like really understanding and what that means for me, you know, the fundamentals, you know, the trade-off, you know, risk-return trade-off, you know, that ultimately, you know, potentially I might need to take a bit of risk in order to enhance my return, you know, to go point to protect the real value of my funds. So I think it's going to be a combination of that. So I think provision of information and support, I think, can play an important role. And again, just get people to the point where they have comfort and understanding around risk, and they can make those informed choices, you know, that align with their needs and their genuine risk appetite.
Just also that issue of the risk, not just the risk of not investing. Inflation's back up to 3.6%, folks. You know, negative real interest rates are pretty negative. You know, our deposits aren't being incinerated the way they were in 2022, but they're burning at current rates. So, you know, you're losing money now by keeping it on deposit. So there's a, you know, a downside of doing nothing.
Before I go to questions from the audience, just one final question on inclusion. If there's a single designer choice to ensure that we have inclusion, what would that be? Sorry, Bob.
Sure. I'm a little bit biased. I think a starter amount for, you know, kids 0 to 3 or born to kind of get them started, or or a matching principle of 50 euros for the younger generation. I think if we start at the very youngest, that it'll actually kind of work through the system. So that would be my personal view.
I think it comes down to the simplicity. We know those knowledge and understanding gaps are there, so it needs to be accessible and easy to navigate. Yeah.
I wouldn't know for engineer though. I think things can go wrong. We look at sort of geopolitical risk right now and the kind of investment in performance we have. So I would simply design the products as well as we can, make them as simple as possible, and that you leave it to the discretionary choice of households to the extent to which they want to communicate.
Simplicity, simplicity, simplicity.
Okay, so I'm going to take some questions from the audience now. I'm going to take them in threes so we can get to as many people as possible. I'd ask that you just state your name and where you're from or who you represent. Comments are welcome. If you don't want to ask a question, but either way, make sure you're short and you're free to direct your comment or question to the panel as a whole or to any member thereof. And someone with a microphone, I think, just over here. So, first question, Devil at your front.
Sit down. Hi, I'm Tom McCarty, black member to IIEA. Listening to the panel, it seems to me that I haven't read much of this, right? But it seems to me, first of all, it's a half a couple of fact, listen, I don't understand, I don't have a clear view of what it might involve or how I would invest in it. So the impression I have is that some politician, probably a Taoiseach, is looking for bright ideas and is latched onto this and it's not being properly thought out or not being given the time that it needs to developers. If you go back a step, we have a system of year where you deem disposal rule after 7 years, which is a half-baked thing to something the Revenue Commission to publish. There has been a recommendation to get rid of that. My recommendation would be do that first. Secondly, I'm not going to comment on the merits of the individual on the proposal as I understand, the rudimentary form that I understand, but it seems to me that one last slide there, I spent about 20 years with government, is that government interference is bad. Generally speaking, when they interfere, the press second make a mess of it. So that would be my cautionary note. But that said, something does need to be done. The only other thing I'd comment on is the taxation end of it. That we're coming from one taxation system, which is bananas, and we're risking going to another one, it seems to be, because the idea that you charge 1% per annum on money from cautious investors, who might well still leave it on deposit, actually, instead of funding it into global equities, which might be the assumption, or infrastructure, even worse still. I can't imagine why they have this money into infrastructure. Certainly couldn't go directly. It might go through a bond if someone was clever enough and brave enough to do a bond charge. But 1% is simply too much. So it should be a capital gains tax. It should be a reasonable rate of capital gains tax. It should be taxed on gains realised, not putative. Thank you.
Another question, Herr Gallant. Yeah.
I am Ruth from Irish Homes. I think about the question here and the gigs this scheme looks to access new capital from deposits. Is there a risk there, however, with existing products that money could funnel out of existing files into this new scheme? And how do we protect those existing products? And maybe leaves a little bit about the tax point that the gentleman has raised in terms of the prohibitive nature of existing tax and environment and for direct investing, private investing in existing.
Please take one more before we go back into the back. Start that they can look in the back there.
Hi there, I'm Harry from Business. And Simon Harris said that he has a breakfast which IS came on that was based on the basis of particularly around taxation. So what is your view on this? And also, but is the policy just more around optimizing household wealth, or would be more about addressing capital funding?
Good. Okay, so Anyone that want to respond?
Yeah.
I'll start first. So one thing I'd say from the outset is about 60% of the people in this room are employed or working off an industry due to bold leadership by the government in setting up the IFSC and putting in the support of infrastructure. And I personally am very encouraged by our politicians to kind of show bravery, look at international best practice and look to lead it for the benefit of all society. The different schemes, Leo, the different schemes have different pluses and benefits, and certainly we as a firm are supportive of all the schemes that are in discussion. They all achieve the objective of getting capital out of deposit and get it invested. And maybe I'm just going to take one thing, and I realise I'm kind of out of my depth intellectually on this panel, but we talked a little bit in the States, and you know, if you look at in relation to Silicon Valley, and there's a little bit kind of research about that. Why did Silicon Valley grow up? Why, when in terms of New York, MIT, all the universities, what happened? Actually, it was provision of capital. It was getting investment, supporting it into the right infrastructure needs and the wider socioeconomic benefits. So personally, I'm very encouraged by the leadership being stolen, and I think also we have to be supportive of the establishment when we start taking policy for the wider good. To deal with the question as regards to investment, if investments move across different structures, will they still achieve the objective as regards being invested? If we get a certain amount of deposits into the market, then that's also a positive route. So I don't see it as a negative because the money will remain invested. That doesn't.
Well, I suppose just a brief comment to that point, and again, I suppose I keep coming back to this. You know, once people are clear, you know, what the purpose of a product is, you know, what benefits it brings to them, then they will end up in the right product, and that will ultimately be fine. Things will settle where they should settle, and I suppose that links to that point around, I suppose the dual objectives of this in terms of, you know, supporting people to provide for their financial well-being, you know, to provide for financial goals, and that really being a primary consideration here. But also, I suppose, in terms of, you know, providing funding, you know, supporting, you know, an active and well-functioning capital market, you know, domestically and across Europe.
I mean, I think I would just add, I agree. I think it is a sensible public policy choice. You know, people probably aren't saving enough for the long term through the markets. We know all about the demographic pressures. We know all about social protection and the pressures on it. And then these are design choices ultimately for government to make choices in terms of how you design the tax system, how you know, what kind of trade-offs you make. But very much perhaps going back to Dan's point, keeping it as simple as possible in terms of just household access and understanding of the system, whether it's through the tax base, how you do the tax bit of it, or how you do the product bit of it.
So just a couple of points in terms of, you know, it's not the government's job to protect existing incumbents. That just, you know, goes without saying. Of course, the government doesn't want to destabilise the financial system. I alluded to that earlier on, the risk of capital flight. But given how sticky deposits have been, as we've seen, I think it's a pretty low risk of that. You know, I don't see there being a sudden huge uptake of this product, no matter how well it's designed. Yeah, just the European context, the question there about who benefits. I suppose the Capital Markets Union, as used to be called, was the idea that, you know, our funding system for the economy in Europe is too bank-based. I think maybe we kind of look to the US and we see the US has done exceptionally well in starting up new companies and building companies, you know, high growth companies. And our funding system in Europe, you know, we're exporting capital across the Atlantic. It would be better if more of that capital stayed in Europe and went into the domestic economy, particularly the start-up high growth economy. So in terms of the Irish context, again, coming back to that point about us having fewer assets to invest in a smaller economy, you know, I think the clear main beneficiaries from this will be the retail saver investor. Could have some upsides for the domestic business economy as well if that money gets channeled in to aspects of the domestic economy. I think in the Irish context, the biggest beneficiary is that retail saver here.
Time for some more questions or comments. Down there, Weird.
Yeah.
Please.
Good morning, panel. The government's track record in putting programs like this in place is pretty poor. It took us 20 years to get auto enrollment in place, which started on January 1st. We had a pathetic attempt or token towards the deemed disposal to reduce the tax by 2 or 3% in the last budget when the industry was calling for complete abolition. So my question is, what political challenges lie ahead for the government to actually get this through, particularly given the fragility of the government that we saw only last week in relation to the fuel protests?
Right at the back there.
Tapping. It's going to the sea.
Thanks. Donald from the Irish Independent. Could I just ask the panel how big they think that this pot is likely to be in maybe year 1 and year 5? So we know there's a lot of money on deposit. Some fraction of that is likely to either move or to stop flowing into deposits. But how big is that actually likely to be?
Okay. One more before we get back. Over here.
From BNY. And a very quick question, just following up on the fact that the EU Commission actually came out with the SIA recommendation rather than putting forward another directive and a regulation. Now, Ireland has kind of grasped this initiative by being very ambitious, very fast with proposals and consulting with the industry. I guess designed well, is there an opportunity, maybe this is a question for the moderator, given he's sat around the table, is this an opportunity for the Irish to take leadership in the EU Council to actually move the debate from lofty ambitions around the need for capital markets union to practical examples, how you build an investment culture and actually realize a savings investment union in Europe?
I'm not sure what to answer that. I did spend 7 years sitting around the European Council table talking about a capital markets union, wondering when it was ever going to happen. Hopefully the shift of things that has happened in the world has now put some impetus around that, and there is a move, I think, by some states to press ahead if others won't. And I think as a country we should hold countries back if they want to engage in tax cooperation, but if that's going to happen we should be part of it. But that's obviously a bigger political call for others to make now. So I might start with Dan. Move down to Alan.
So, as a policy wonk, and forgive me, Leo, in terms of being an observer and critical government often in Ireland, that we suffer from a sort of implementation deficit disorder. There's a lot of inertia in the system. But this is very different. The momentum behind this seems to me to be extremely strong. I think there's a number of reasons for that. One, it's just a good idea. And two, in a European context, as we take over the presidency, I think Ireland will want to be able to say, look, we're in favour of savings investment union, and we're doing it here on domestic level. In terms of Donald's question, maybe 10 billion for a year. That's a pure guess, but I think that will be a success. And then just this whole issue about, when anybody talks about changing culture, it's all those expressions that gets me reaching for my imaginary pistol. It's not. I think that's just too big a. It changes the options savers have to protect their wealth and grow their wealth. That's a good thing.
Maybe 2 points. I mean, in terms of what might happen in year 1 and subsequently, I think it's very, very hard in any way to come up with either an optimal kind of outcome or what might happen. I think this has to be incredibly organic. Again, not to belabor the point, where we are in terms of geopolitical risk and with volatility in markets, I think this really has to be seen in the long-term horizon in terms of change in household patterns. And I think maybe just a bit of experience from across the channel. So as many of you will know, there are two forms of ISAs, these tax efficient accounts in the UK. There is cash ISA, and then there's an investment ISA. There is multiples of greater levels of deposit into the cash ISA, which kind of goes to the fact of the stickiness of deposits. So I think that's something that's always important to put in the background. And then, I mean, in terms of the European space, I mean, absolutely. I think one thing, though, I found interesting when I was doing some reading up around where the Commission has been coming from on this and the kind of research it's been doing, it did canvass investors and consumers and citizens. So it did do sort of outreach. What was interesting was, I think, two things were coming back, and there are things worth being alive to the policy space on this. One was, yes, a good idea, but it has to be surrounded by guardrails, and that's really important in communication and the policy implementation here. Second one was kind of interesting. It was sort of, is this some kind of incursion into our, our autonomy as citizens in terms of what we do with our savings? So I think that's something you're a little bit conscious of as well. You're not being kind of promoted to put your savings in X so that can help Y. So going to the policy implementation point, there is a job of work there on the whole communication space around what this is for.
Okay, just a couple of comments. I think I'd agree. This is a long-term initiative. This is about changing behaviours and driving towards developing that investment culture. And I think that will inevitably take time. So I wouldn't want to put an estimate or a figure on where we think we might be at the end of year one. And I suppose just the second comment I'd make, just in terms of Ireland moving reasonably quickly with this. I mean, I think, of course, others will watch, and others will want to see how this goes, and others will look to I think, learn from Ireland's experience, and this, I can't think that's inevitable.
And I'm afraid I've been shocked by Dan's imaginary pestle here. If you apply the models in relation to the Swedish model and you kind of do some sort of proxies on a 5-year figure, you could be up to 50 billion if it replicates. It's not to say that it is, but as a frame of reference. To go to the Bernard's point, yes, I think we've had challenges in the timely disposal, transition of legislation to kind of keep pace with the industry. That kind of highlights the risk that we talked to Tánaiste. But I think to me, the glass is half full. There's been a very clear commitment, and it's important that we as a stakeholder group help drive this forward and help support that and help lead the narrative. And then going back to your point, Ben, I think it's important that Ireland helps to lead within the EU. I think I think if we can kind of show that it's kind of working here. Now, I realise with representation from the Swedish embassy here, and they rolled out this many years, but showing that we can kind of learn from best practice and apply it quickly, and that everyone benefits. I think it's a great platform. It's where Ireland needs to be, and it's a good start to our presidency.
I think we have time for one more round. Down at the back there.
Hi, Pat Larkin, Irish Points. First of all, thanks for the reporting hosting this morning. So more just a couple of quick comments. Agree it's about encouraging and making it easier, not about where the money should be invested, because there's other people's money, I think is noted in the report. I think on the enabling piece of it, the deep disposal removal will start to take away one. We haven't talked about, in terms of making it easier, the fact that we have 5,900 regulated products that cover every conceivable asset exposure, that cover every conceivable geography, have product rules, are being distributed all over the world. So actually, for that part of the solution, we're in really good shape if we use it. I think for the longer term piece, we have a retail investor AIF, then you can start looking at how you put money into infrastructure, into housing, into less liquid assets. Strategically, I agree with the point that Dan made, it is important for Ireland to be shown and to be seen to have a role in supporting the EU savings and investment use, where we probably don't have as much strength in other politically strategic areas, particularly entering into the presidency. I would say from a cultural point of view, I agree again, culture is about behaviours. Behaviours are about incentives. And I think that we should view this, not in the short term, as a part of Ireland's overall competitiveness, national competitiveness. This is a portion of it, because a well-invested, well-deployed capital base is important for the broader national account base.
That's it.
Okay, so
Thanks very much. Patricia Callan, I'm the Director of Financial Services Ireland and IBEC, and we've had a group working on this across all the sectors. So funds have obviously had a lot of experience, but also fintech, banks, insurance companies, etc. And there's massive momentum. I think that's what the government has really cottoned on to, the idea that we can do this in a very short period of time and into next year. And I'd also just like to make some broader comments, because obviously a lot of what the panel has discussed, there's been a lot of conversations and there's huge consensus around this. But I do think fundamentally, how many people do we all know who are third level educated, in great jobs, who have no investment? And that is remarkable. And that's really what we're trying to craft here, the idea of getting people to focus on this, to kickstart a conversation around investment, that then we'll have huge gains will flow from that into more sophisticated people who will be willing to pay for that retail advice once they've had a first taster with the government incentive in a really easy to use account. And that then will really spill into the next generation. And I think the other key thing that we really need to be wary of is, in Ireland we love to cross-populate policy priorities, and the conversation today really spills to that in terms of whether it should be for housing or for national business, etc. But I think if you up everybody's risk appetite, in the end all of that will sort itself too, because you have more people then wanting to invest in small Irish businesses, and we will get the vehicles to invest in infrastructure. So I think this is a real win-win. But conceptually as well, one thing to point out is that in a lot of other countries, this has been net new investment. So it's not coming from deposits, and it's not coming from existing investment funds. Simply the spark is enough to get more people to put a few quid away every month. And if you can do that at small levels without professional advice, then that's going to be the secret sauce to our great success. And it's essential for, I think, our obviously our government, our citizens, and our industry. But if I might, I just pose one question back to Leo, in the sense that enhanced cooperation, I think, is a huge danger to our market here. And if these countries are going ahead and we're not, then that sparks a massive issue around how the EU works. So I do think it's one for us to watch politically as well.
Didn't agree to answer any question. I will add that, but just to clarify for anyone who thinks otherwise, I do not speak for the government or the party anymore, just myself. Anybody else? Dylan here. And is that everyone?
Right. Look, Tim Ham don't really represent anybody except, to some extent, I've tried to invest in all the different options available in Ireland right at the moment. And I just want to pick up two things. I suppose Dan's point about simplicity, I think that's what we have to agree with that point. And I just wonder, we've talked about looking at different schemes in different countries that have to work out what's good and what's bad about them. I wonder, has the panel really done any, looked at the available options here in Ireland right now, and what works with those and what doesn't? It seems to me when I try to deal with this huge number of barriers that make it very, very difficult sometimes to invest in anything that you really want to. So the question is, let's look at what we have and see what works and what doesn't and what can be improved on. And the second point, I really like Niamh's emphasis on basic things on local experience. But there's been a lot of talk about risk appetites. I think most people in Ireland probably have a very good understanding of risk and how it works. Everybody's gone for bookie shops at some point. You put money down on horses, you put money down on sporting events. You have a good idea of what you can lose and what the stakes are. So as long as you can keep it, as long as you treat people like adults, you give them a chance to make decisions, give them information. I think otherwise you have to do what these should be able to do. What more does one come on? Thanks.
I think we've got better growth, which is great. Impressive. Code. Oliver?
Me again. Emma, I'm from the business post, and it says in the paper that all providers PIA conduct should be responsible for the tax reporting of their PIA conduct. So I wonder, is it worth reconsidering the necessity of providers to report taxation that excludes then travel rates?
Okay, but just in relation to Tricia, I think as people will probably know, since there was a treaty establishing the European Union, a core group of member states can come together. I think that's to be fine or more, and decide to integrate together and use the institutions of the European Union to do so. But every country doesn't have to be involved. A consideration that Ireland always has to have is that if we see ourselves as part of the European Union and we see ourselves as that being beneficial, we're already sort of not fully integrated when it comes to defence. We're not in the Schengen area because of the common travel area. We also have an opt-in, opt-out system for justice and home affairs, which is to bear in mind that if the list of things that we're not at the centre of gets longer and longer, that does have consequences as to what extent we are really at the heart of things in Europe. So back to the ballot. Start Paul at the Indian.
Well, maybe Dan, in relation to the kind of the findings of the report, in terms of, I know the IIEA, the independent organisation, would you like to kind of comment on the structure? I think one of the things that kind of came out of the round table is simplicity. And there are different schemes, like the UK is one area that offers simplicity, and there's a Swedish model. But Dan, I don't know, would you like to comment on that?
Well, ultimately, I think we're agnostic. We didn't want to be too prescriptive. We don't need to reinvent the wheel on this because there are existing models. I think none of them are perfect for the Irish context, and there's a bit of tweaking involved. But it shouldn't be rocket science, and I think it can be done quite quickly.
There's a lot there, but I suppose what strikes me with the conversation, we've had a lot of discussion around people being empowered to make good decisions for themselves, and I think that is core here. And I've probably spoken quite a bit about, I suppose, the role of firms or distributors in terms of providing good quality information and, where appropriate, good quality advice and other supports. But I suppose something that we haven't actually spoken a lot about this morning is maybe the other side of that coin, which is financial literacy. Because I suppose good quality information needs to, I think, meet a basic level of financial and indeed investment literacy. And I think this goes to your point that this is going to be a multi-year, organic process. Because and the National Financial Literacy Strategy speaks to this and identifies this as an area of focus, and I think it'll be a combination of factors. But I suppose what's interesting about this, and this certainly has been demonstrated in other jurisdictions, if you get people started, that's a great way to actually build financial literacy. You learn by doing. And I think there's potential for this initiative to play a role in that.
Thanks so much to you and for all the observations. It was super interesting. I guess maybe just 3 really quick points. I mean, I think the first thing is there's no magic product out there. If there was, we'd all be buying it. I'd be buying it, right? So what this is about, the fundamentals of investment do not change with this. This is the government deciding we're using some of our tax capacity to nudge behaviour in a particular direction in the public interest, which is absolutely fine and appropriate thing to do. So then what you're trying to do is sort of nudge, package, direct, whatever phrase one wants to use, people into this kind of investment. You can use a tax capacity to do it, you can label it in certain ways, you can have fuzzy websites, and that's all absolutely fine too. But I think it's really important in how this is managed, that we're not constructing some golden thing out there that's going to do something different in terms of what the investment process looks like. And this simple accessibility, digital platforms, really super advice and guidance around it, really, really important here. And I think maybe just the final point on it is that it sits within a wider ecosystem of things, whether that's financial literacy or guidance or advice or industry events or the media kind of talking about this. It's not something that sits in isolation.
Yeah, just a final, just for those of you who aren't members of the IIEA, this is the sort of thing we do. Question that just being discussed in terms of, from Tricia's point and Leo's response, we're at a very critical juncture in Europe at the moment, and it's not getting nearly enough discussion in terms of choices we're going to have to make to opt in or opt out. The world has profoundly changed. And if you just want to know more about it, you're not reverting to it.
So I'm afraid we're out of time. Just on my own behalf and on behalf of the board of the Institute, I want to thank our panel for giving up their time this morning to discuss what is a really important and really interesting issue. I also want to thank you, the audience, for your engagement and also BNY for hosting us here this morning in this wonderful venue. So now to bring the event to a close, I'd like to hand over to our Director of Research, Dr. Barry Colfer.
Thanks so much, Leo, and I'll be very brief, everybody. Thanks for staying with us. Oh, good Scale. I press a button, do I? Oh.
Pick it up. There you go.
How are we speak?
Yeah, that should be good.
How are we? Great stuff. Apologies. Barry Colfer from the Institute. Thank you very much, everybody. Just to thank BNY again for this great collaboration, this wonderful venue. I really feel that we're contributing to an important policy discussion here after the central bank's SI forum last month and other important interventions. And at the Institute, Dan kind of stole a couple of my lines, but the idea of trying to add visibility and clarity around some of these important issues is what we try to do at the Institute. I want to thank all of our panellists and indeed Leo for your time, but also there's a bunch of you in the room and you know who you are, who contributed at various stages to this process in terms of the roundtable and reading various drafts of the paper, so thank you for your time. And also just a special word, not just today, but BNY are really great supporters of the Institute. They're very consistent and kind of quiet supporters of our work with years, and it's really appreciated. Without the support of BNY and other members, we couldn't do what we do. I want to especially acknowledge Sharon Moynihan, Ben Potts and Ty Toomey, with whom we've worked for over a year on this project, believe it or not, and it's been good fun, and I look forward to the next one, guys. Just a penultimate word, the paper is available and the paper is good, Designing a PIA for Ireland. It's on our website, there are QR codes around, but also there's been a very limited print run, so if you move quickly, you can get your hard copy, and both the authors are here, and you can get your signed copy. Dan O'Brien here and Kieran Donoghue, both of whom did a great job pulling this paper together. So just finally to say, I think we have the hall until 11, and I invite you, for those of you who can stay, if you want to partake in a bit of hospitality put on by BNY in the cafe, which last time I checked I think is behind us here, is it? Great stuff. So for those of you who can stay, please stick around and have a chat, and thank you very much for giving us your time.
This podcast is brought to you by the IIEA, sharing ideas, shaping policy.